So stablecoins are once again in the news. In a story published Sunday in the New York Times, we got to look at both the growing likelihood that stablecoins will be regulated and, at least in the US, the different ways that they could go about doing it. The article postulated that they could designate them as a risk to the financial system, which would put them under regulatory control, even if the activity that they are saying will be a risk is only a risk down the road. They could call them securities, which would then put the SEC in charge of regulating them as securities and also have major implications in terms of how and who can use them. They could treat them as money market mutual funds, which some experts say they resemble and which are also regulated by a different regulator. They could regulate them like their banks under the OCC, potentially bringing stablecoins into the Treasury Department effectively. And they could issue a competing central bank digital currency, something that the Federal Reserve is currently studying. So the one thing that they know is that they need government approval in order for these things to be things that we can legally use. Naomi, I'll throw to you for this one first. What do you think?
Well, I'd also just like the angle that this kind of shows the zeitgeist that regulation is on the horizon because we have a feature in the New York Times. And it also goes to speak for the fact that media outlets, just being a mouthpiece of the state, historically, this has always been so, and it continues to be so, even as we start to decentralize, government moves along with that, finds ways to kind of co-opt the system in that. So it is kind of interesting that this article takes that approach and says, oh, New York Times is talking about it. Clearly they're in the know and they're setting the foundation so that, government can then go after stable coins. I mean, it is interesting because we sort of already read the tea leaves on this with the Coinbase lawsuit when they're saying, hey, SEC is saying, hey, you can't have this lending product because it clearly involves securities. And the only thing it involved was USDC, right? They weren't planning on offering their lend service with any other product to start off with. It was just USDC. So it's like, okay, is this a security? Is this going to be regulated as such? And obviously it's up in the air how this actually is going to be regulated, which department is going to take control. Gensler has been so aggressive in claiming everything in the crypto space as a security. It's probably going to be a battle amongst the government as well. But they do have these, sort of task forces that they've put together with a bunch of different departments. I wouldn't be surprised if someone like Gensler or the SEC kind of takes the lead and spearheads these departments anyway, because they really have, taken a lot of territory in that space. So it'll be interesting to see which government department claims this. Also, I mean, it's so interesting that they say systemically risky. It's such an interesting term to unpack. Like, yeah, it is kind of systemically risky. But I also think that what the government is doing is systemically risky as well. And when they talk about applying protection and they say, well, maybe this should be considered money, and so we have FDIC insurance, and then consumers can be protected. We have to dig into that too, because how much of consumers actually being protected by FDIC insurance? Isn't it like 1% of accounts are covered? So if there is a bank run, FDIC is going to do squat, right? It's just this false sense of security so the government can seem like they're protecting people so people can feel comfortable. But at the end of the day, it's kind of this moral hazard because people are using these risky products under this false illusion of security. And if that applies to the crypto space as well, and people start to think that this is more secure than it actually is because it has FDIC insurance, I think that actually creates a bigger systemic risk than anything they're worried about. But Zach, I'll throw to you.
Yeah, I mean, I think the thing about this whole conversation is that, you can't discount the fact that stablecoin issuers in the past have been a bit dodgy as to whether or not there is $1 backing every stablecoin out there in the world, right? So if these things are to become systemic, I don't think they're systemic anything yet. They're still pretty niche in terms of usage, but we are seeing stablecoin numbers in the world rise, and we are seeing more mainstream firms embrace stablecoins like USDC as a way to provide cool, innovative fintech products to the world. There is legitimate questions about whether or not these assets are redeemable for what they claim to be worth. And so I think the crypto industry has sort of a sordid, checkered past when it comes to the stablecoin issuers, and now we're seeing that sort of, I don't know what's the idiom I'm looking for? That chicken come home and roost or whatever. Is that the idiom? As these things become, yeah, exactly, right. So Tether has a long history of this. USDC only recently became more forthcoming about which assets are backing these things, right? As these become huge, multi-billion-dollar pieces of the global economy, it makes sense that someone is going to take these companies to task when previously they had not been taken to task. So you know, I don't know. I do want to pipe up for like responsible regulation or whatever that would be in this case, because there have been issues in the past as to whether or not $1 stable a dollar-backed stablecoin actually has dollars backing it. Jen, I'll toss it to you for your take.
Yeah, I'll add my take in quickly and pass it back to you, Adam. This isn't surprising if we look at what the regulators have been saying about stablecoins up until now, what's been happening with stablecoins, to Zach's point. I want to point to something that Sam Bankman-Fried recently said. He said that a ban on stablecoins would be sad, but regulation could have a more positive effect for investors. So I think that just supports what you're saying, Zach. And we've said on the show before that regulation isn't necessarily a bad thing. It tells us what we need to push against, and it gives us some sort of framework to have the conversations that we have every day on this show in a more productive way. And so hopefully regulation can bring some more clarity to what's happening in the crypto space, and we can finally start to move forward instead of just like spinning in circles. But Adam, I'll pass it back to you to wrap us up.
Yeah, so I mean, just wrapping it up, I think that when we look at these types of things, really what we're seeing here are two incompatible systems that are attempting to reconcile each other and incorporate into each other. On the one hand, you have the traditional state, which is basically saying that we don't want to change any rules, create any new rules for you, or really do anything that's going to assist you in this in any way. In fact, the only thing we're really interested in doing is standing in your way because you present competition to us, and this is a way that we can do that. On the other side, you see sort of the world of cryptocurrency broadly saying that we have a better way to do these things. We don't need the rules that you created for your older systems that were much worse because we've done it in a way that doesn't require those. And so why would we cripple our product in order to come into compliance with rules that shouldn't even apply to us? I think that they both are perspectives that have valid points associated with them. And I think that really that's the game we're going to be playing over the course of this next year. But it's a topic for another day.